If this economy slows down, if inflation starts to cool down, isn't it possible that the Federal Reserve, while everyone's like, they're going to raise rates 100 times, 200 times, 300 times, they could change on a dime, could they not?
Of course, I think they could be flexible based on market conditions, but I've basically been saying that I feel that there's limited upside right now until the Fed ends this hawkish tone. For example, I've been bullish since the pandemic lows for two main reasons. The technicals were improving and the Fed was providing all of this insane accommodation, not only by keeping interest rates low, but with all their bond buying. They did more treasury purchases in the 6 weeks following the pandemic than they did in 9 years combined between 2009 and 2018. And they continued with that $120 billion a month in bond purchases. But then when I appeared on your network in mid-December of last year, I turned cautious for the opposite two reasons: that the technicals were starting to break down and the Fed was taking away all of this accommodation, not only by ending their bond buying, but also by raising rates this year and potentially reducing their balance sheet. So again, my conclusion is that the market's unlikely to see sustained upside until this rate hiking cycle ends, or at least until they do a couple of hikes and they pause. But I also want to stress, it doesn't mean the market has to fall apart. It just means that we could possibly be in a range to digest last year's gains. And also, there are still tremendous opportunities in the market out there, especially in the energy commodity related, some of the big pharma names. So there's still opportunities, but investors have to just be a little bit patient and wait for this rate hiking cycle to end before we see sustained upside.
Well, Joe, you're being way too nice. The Fed is not just ending accommodation, okay? It's not just taking the candy out of the kid's mouth. It's taking the candy out of the kid's mouth, throwing it on the ground, stomping on it, and then tossing it into garbage. I mean, if they are going to do what they say they're going to do, the rate hiking cycle, and the bond market, by the way, already reflecting that, with interest rates basically doubling, is going to be fast and it's going to be violent. So you say, when they're done hiking rates, when do you think that's going to be?
Well, that's a great question. It really just depends on how aggressive they want to be. If you want to use the 2018 analogy, they were raising rates all through 18 and continued into the fall of 18, and they didn't end that until the S&P corrected 20%. And that's when Powell pivoted in early January of 2019. So that's one example. The other example could be maybe it ends when they reach certain goals. Maybe they want to get to a certain Fed funds rate as long as it doesn't break the market. That's another possibility. And then the other thing I was thinking about is that midterm election years tend to bottom statistically around August, September. So this could go on for several months until the Fed reaches their objectives. But that's why I'm really stressing to be patient and defensive until this cycle is done.
You think oil stocks, energy stocks, still a good bet here, Joe?
Right now, to be honest, that's the main thing that's working. I don't think it matters whether oil's 90, 105, 120. These companies are printing money, energy, commodity-related, fertilizer-related. The analysts have their models based on $50 or $60 oil. When these companies start to report earnings, I think people are going to be shocked at how much profits these companies really have.